Who's the kind of person or entity that would stand for deliver to the tune of $2 billion in silver?
Well, I mean, in China, it could be a speculator, I don't know. But the majority of demand, I mean, almost all the demand at the moment is actually industrial. We're seeing the gold-silver ratio drop. But the idea that, Joe Public is sort of thinking this is a cheap way into the gold story. Gold's gone. We've missed that. We've got to get into silver. Mm-hmm. It's got a big catch up. The story basically is fiat currencies are in trouble, and therefore silver will return as a monetary metal, good and prop. I don't think the public are buying that at all. I really don't, not yet. And I think that the squeeze is really the result of years of greater supply than mine demand was, could satisfy. And it's just sort of caught up with things a bit. So a lot of this move is rather like, when you get a dislocation in the market, the price just goes crazy. We saw this with nickel on the LME, was it 18 months ago? In that case, it wasn't a shortage of nickel. There was a shortage of deliverable nickel because the nickel had to be delivered, if you like, in accordance with what was required under the LME contract. And it was a Chinese nickel business which had loads of nickel, which it could have delivered, but not in that form. So it reneged on the contracts. And of course, the LME then had to sort of strike out any contracts that were taken out over that period. In the case of silver, it's different. It's not there. It is not there. It's gone. It's as simple as that. And of course, the other thing is that any industrial entity which has got a stockpile, is it going to let it go? In the past, it might have traded a bit, but under these circumstances, oh no, certainly not. We're going to hang on to our silver because we won't get it back if we put it into the market. So it's almost become, it's a Giffen good. I've written about this a few times. A Giffen good is one which sort of upends the normal supply and demand relationship being sorted out by price. Price rises and, supply increases as a result. No, what's happening is that as the price rises, the supply is diminishing. And that's having a catastrophic effect as far as industrial users are concerned. And of course, it's only just beginning to catch the attention of people in the markets who are sort of thinking, should we speculate by buying silver? Should we buy silver ETFs? So, Indian ETFs suspend operations back in the beginning of October because they couldn't get any metal. You could easily see the same sort of thing happening with ETFs in the West. SLV and so on and so forth. They may be forced to do that. I don't know. There's just no silver. I think that's the point, Dan. The spot price rising more than the futures price. I think that's just showing, if you like, that the squeeze is on. The squeeze is pushing up the spot and the futures price is either following or it'll go into backwardation, whatever. I mean, the two things aren't directly related. You're not getting the arbitrage, Danny, whereby someone sort of looks at, lease rates and all the rest of it and, premiums and things. We can trade this. They're not doing it because there isn't the liquidity to do it. Because, if you're going to sell silver into, in order to do an arbitrage, whether you do it out of futures or out of London, you've got to get the stuff back. So people, I don't think, are really playing these small nuances. The one thing I've noticed when it comes to stocks, which is what SLV is, if you like, is that the price isn't necessarily tied directly to the commodity. And what we could be seeing, and I don't know that this is the case, but what we could be seeing is that the prices may be held back a little bit as authorized participants decide to borrow some stock, not shorted, but borrow some stock, submit that to the trustees of SLB and say, come on, we want 100,000 ounces, whatever the equivalent is. There are those games going on. Which is one reason why I'm not sure keen on having ETFs. I mean, if you're an investor and you can't think otherwise, then go and play in the ETF markets. But if you come a cropper, just bear in mind, you're not buying physical metal. You're buying a piece of paper, which is a derivative of it. No more than any other derivative. if derivatives are in danger, then I would suggest that ETFs are not necessarily the best way to play this market. I think the answer to that, I mean, I've been watching, in London, we've got the largest silver mine in the world, actually, Fresnillo, listed on the London Stock Exchange. And it's been interesting to see how that performs relative to the silver price. It doesn't run ahead of the silver price. It's behind the silver price most of the time. And it maybe catches up a bit the next day. The idea that correlates quite well with the silver price, the idea that investors looking to buy or sell Fresnillo, SLB or whatever it might be, are actually sort of bullish on silver. No, they're not. I mean, the prices are being dragged up by the physical market, not by investor interest saying, silver's the game in town, we got to go for it, we're going to buy this one, buy that. They're not doing that. They are totally absent. And the result is that the prices are being marked up or down, more or less on yesterday's performance, if you like.
So there's a lag involved when it comes to the mining
I think there's a bit of a lag. And I mean, basically, if you are beginning to get, the price of, let's take an index of silver stocks. If they really started to move ahead of the game, then quite clearly it would be the investment community saying silver is in a bull market. We got to buy these mines. Yeah, they're not doing that. Honestly, they're not bullish. You and I and others, if you like, who've been following gold and silver for some considerable time, could express our views by saying we're bullish of gold, we're bullish of silver. And I've just explained why the market is short, et cetera, and that's going to drive the price higher. But the investment community as a whole is just not interested. They don't understand it. They would rather chase the Nvidias and the tech stocks of this world. I mean, when we start talking mines, average investor he's clueless. He's got no idea, and he doesn't want to know, really. I mean, it's just too difficult. Just give me the things I understand, he says, I think. I think that's why you've got this sort of extraordinary situation where the response from silver mines and, encapsulated in the indices, and also for gold as well, and other mines in general, is just a complete disinterest from portfolio managers. Silver, there's no doubt about it, there is a liquidity squeeze. And in fact, in both gold and silver, we've got this extraordinary situation with metals going into new high ground or not far off it, definitely in bull markets. And the speculative interest on the buy side, as it were, is minimal. I mean, if you look at the open interest on COMEX for gold, that's less than 420,000 contracts. I mean, that's sort of oversold level. I mean, not deep oversold, but pretty near it. And this is the fascinating thing. Gold and silver are rising without any speculative input. It's obviously a little bit, but I mean, it's tiny. If anything, I mean, it's really a squeeze on the establishment, on the paper establishment. And I think that, particularly in the case of silver, it's very difficult for the establishment actually to close out their positions. And consequently, we could be seeing, if you like, the end of the silver contract in both forward markets in London and also on COMEX. Now, that's quite a statement, because so long as I've been looking at the relationship between physical and derivatives, there have been gold bugs saying the derivatives are used to suppress the price of gold, suppress the price of silver, and so on. I mean, undoubtedly that is true. But if that's coming to an end, then there is going to be massive buying pressure from that end alone. As people move out of paper, where they've got paper and they think they've got exposure to the price, as it were, they'll move out of paper and have to move into the physical. So I think we're seeing potentially momentous events. Silver could be breaking, if you like, the commodity derivative system. And that's a fascinating thought.
If it's not retail buyers taking this thing up higher, who is?
Well, this is the point, Danny. It's not buyers doing it. It's basically the shorts refusing to go even shorter. They're trying to control the position. And worse than that, they're finding the few buyers in the market are standing for delivery. I mean, there's a fascinating thing which happened last week, I think on Thursday. There was a story apparently going around the Shanghai Gold Exchange and the Shanghai Futures Exchange that there was going to be a large stand for delivery in Western capital markets. Oh, yeah. And there was, actually, as it turned out. We're talking about 36 million plus ounces of silver in a stand for delivery on COMEX. And coincidentally, the whole of the COMEX system had a data fault. Now, did they pull the plug because they couldn't resolve the situation? I mean, we're talking about a delivery of $2 billion worth of silver. This is large. There was also a very large delivery of gold, over 58 tons on that same day. So, I mean, I think the markets are showing huge, great strain. Now, the fact that the rumor started in